If the IRS asks for records and the taxpayer or a third party won't cooperate, the IRS can escalate to an administrative summons. Think of it as the IRS's legal show me the documents tool. On the EA exam, the key is knowing what a summons is for, getting testimony and existing books, papers, and records to determine or collect tax. A summons has limits. The IRS can't use it just to harass you or force you to settle, and it can't require someone to create documents that don't exist. That includes, go prepare a tax return if one hasn't been filed. Exam tip: when you see create or prepare new documents, that's usually the wrong choice for summons authority. Service rules matter too. The IRS must follow specific procedures to serve a summons. Generally, it has to be delivered in person to the taxpayer or left at the taxpayer's last known residence, and summonses can go to third parties like banks or businesses. A famous version is the John Doe summons, where the IRS seeks records for unidentified taxpayers, like heavy crypto traders. Now switch to spouse issues. When a married couple files a joint return, they get joint and several liability. That means each spouse is legally on the hook for the entire tax, plus penalties and interest. Even divorce doesn't automatically change that. On the EA exam, watch for traps like, the divorce decree says the other spouse pays. The IRS isn't bound by that agreement. Relief from joint liability comes in 3 flavors. Innocent spouse relief is for additional tax from a spouse's unreported income or improper deductions. Separation of liability allocates the additional tax between spouses or ex-spouses. Equitable relief is the catch-all, including cases where the return was correct but the tax wasn't paid, and holding the requesting spouse liable would be unfair. Don't confuse innocent spouse relief with an injured spouse claim. Injured spouse is about refunds, not liability. You filed jointly, you were entitled to part of the refund, but the IRS applied the whole refund to your spouse's past due debts, like child support or student loans. The fix is Form 8379, Injured Spouse Allocation, to get back your share. An offer in compromise, or OIC, is a deal to settle tax for less than the full amount owed. The IRS can accept an OIC on 3 grounds: doubt as to collectability, doubt as to liability, or effective tax administration, also called exceptional circumstances. That last one is the weirdest. The tax is correct and collectible, but collecting it would create serious hardship or be unfair. OICs are paperwork heavy and eligibility driven. To even apply, the taxpayer must have filed all required returns, made required estimated payments, and not be in an open bankruptcy. Employers must be current on deposits for the current and past 2 quarters. Most OICs use Form 656 with a fee and initial payment, but doubt as to liability uses Form 656L and has no fee. After acceptance, compliance is the sting. Stay current for 5 years, or the deal can be terminated and the full liability reinstated. In which case, may the IRS accept an offer in compromise for less than the full amount of the balance due? Is it when there's doubt the assessed tax is correct, when there's doubt the tax is collectible, both of those, or only after the IRS refers the case to the Department of Justice? Think about it before you answer. The correct answer is both. The IRS may accept an OIC when there's doubt as to liability and when there's doubt as to collectability. That's straight out of the 3 OIC grounds. The tempting wrong choice is picking only collectability, because that's the most common OIC people think of, but liability disputes can also qualify. The IRS has authority to issue a summons in all of the following instances, except which one? To require a taxpayer to create a tax return when he hasn't filed, to prepare a substitute return, to determine a taxpayer's liability, or to collect an internal revenue tax liability. Which one is outside summons power? Think about it. The correct answer is requiring the taxpayer to create a tax return. A summons can compel testimony and production of existing records, but it cannot force someone to create documents that don't already exist. The tempting wrong answer is the substitute return option, but the IRS can use information it has to prepare an SFR without forcing the taxpayer to draft it.